Hello and welcome back to a brand new episode of Majlis and Markets with your host Hassan Javraj. Majlis and Markets brings you thought-provoking conversations with influential leaders in Islamic and global markets. Wherever you're listening to us, please remember to like, share and subscribe. Get in touch with us also by sending us an email, hassan@majlisandmarkets.com. In today's episode, we're diving into the booming world of private credit. According to the IMF, private credit assets grew to $2.1 trillion globally in 2023. With banks less willing to lend to riskier firms in the US and Europe, private credit has stepped in as a key lender. In the GCC, private credit activity has also surged, with financial institutions setting up new funds and financing transactions. To help us understand this trend more, we spoke to Ahmad Al-Anani, co-founder and CEO of Sancta Capital. With over 20 years of experience in debt restructuring and structured lending, Ahmad shares his insights into the growth of private credit in the region and its future. Al-Anani, welcome to Majlis and Markets. Great to have you here.
Thank you, Hassan. It's a pleasure to be here.
Ahmad, you and I go back quite a long way. I first got to know you back in 2013. That feels like quite a long time ago, 11 years ago, when you were at Exotics. And I used to speak to you when I was first starting out in journalism, writing about Islamic finance. And this was back in the days before Sukuk became a mainstream asset class as it is today. But obviously you've transitioned to more of like the special situations, distressed debt sort of thing. But before we get into all of that, Ahmed, I really want to get a take on your background. Could you give our listeners like your early life and how you got into like finance and how you got into where you are now?
Of course. So I'm originally Palestinian. I was born in Jordan, lived half my life as a child in Jordan, and then my family moved to Canada, where I did my university. And in university, I followed my passion, which was mathematics. And towards the end of my university career, I had an advisor who is still, a very close person in my life till today. He came to me, and when I did my final dissertation, he said, he just looked at me and he said, I don't see you as a person pursuing academia. So what I'm going to suggest to you is that you infuse your final year with a couple of finance and a couple of economics courses, which I did. And that's when I got the bug. And I, in my senior year of university at the University of British Columbia, I was recruited by Royal Bank of Canada, where I did, kind of a rotation in capital markets for a couple of years. From there, I then moved to New York City, joined a multi-strat hedge fund called MD SAS. I was part of their distressed strategy and mostly looking at distressed and stressed situations in North America, and that's where I really honed in my credit skills and got to learn about credit investing, and that was my foray into the asset class. Then from there, I moved to the UK. I joined a firm called Exotics, which was an offshoot from ICAP. Exotics it's now been absorbed and acquired by multiple parties. But at the time, the firm had a real niche in making markets in high yield, distressed, and illiquid emerging markets debt. And I joined them. And the focus was to build out, a distribution base for the firm in the Middle East, essentially targeting sovereign, quasi-sovereign investors and importing capital from the region to outside, to opportunities elsewhere that the firm was focused on in emerging markets. And as I started visiting the region, I found myself putting to work my Arabic language as well as my acquaintance with the culture and my affinity with it, plus my Western training and discipline training to use. And I came to see, and I saw the opportunity set with a very different eyes. And I came back to my firm. This was around, when the financial crisis was bubbling. I came to my colleagues at Exotics, and I said, we're approaching the region in a very different. We're approaching the region in a wrong way. We should be actually deploying capital into the region, because this is a region that is full of inefficiencies, and it is a severely underinvested region. And I can, exploit my skills to good use and identify investment opportunities for us and our investors outside the region. And then, in a way, when the financial crisis really, took hold of global capital markets, um, the region kind of was like in a bit of a bubble where it didn't respond, and there was a lot of this talk about is the region decoupling from global markets, is emerging markets decoupling. It really felt like it was people were behaving in the region as if they're immune to what's happening in the US and Europe, and that didn't sit well with me. We made a couple of calls that ended up working out really well for the firm on the short side. And then when finally the crisis hit the region, and it hit really hard, and credit completely froze, particularly in the UAE and in Saudi Arabia, we actually turned into buyers of debt from the region, because the discounts to par were just eye-watering. So then that worked out, and by 2010 there was enough critical mass behind what I was doing at Exotics, sitting in London, focusing on the region, that it actually necessitated moving to the region. And I moved to the region in 2010. By 2014, I spun out with my partner and co-portfolio manager, Gus, and we set up Sancta Capital. So that's my journey.
Fantastic. And what do you do at Sector Capital today?
So Sancta Capital, I mean, the way we describe it, I mean, we're the only on the ground firm focused on special situations and deep value in the Middle East and North Africa. We invest across the corporate balance sheet. So we do listed and unlisted or private. We do credit and equity. And we follow a very disciplined value investing, bottom-up driven investment process. We take concentrated bets, and we work towards very specific events to help our investee companies, our portfolio companies, to reach their full valuation potential. That could be something as simple as working with the management team on improving IR, increasing investor education and investor outreach, inviting sell side analysts to help, kind of bring the company to light to the investment community. Or it could be a little bit more complicated, where we, have to sit as independent, or we have to sit as advisors to the board, or members of the board, and we provide our advice and our input on capital allocations, refinancings, sale of non-core assets, etc., as means of creating shareholder value or stakeholder value. Or it could be a little bit more involved, where it's a distressed company that requires resizing of the balance sheet and the restructuring of the balance sheet, where we could chair or lead an ad hoc committee to achieve that purpose, and engage with the company, the borrower company, to achieve that purpose. Or it could be even more involved, where we have to be activist or litigate as a means to protecting our rights or enforcing on security, etc.
So it sounds quite bespoke to your clients, right?
I mean, we have a single strategy, and we have a very diverse network of investors and limited partners that includes sovereign wealth funds, institutional investors, and family offices, and high net worth. But in terms of how we manage our process, our investment process is single strategy that where we channel our entire intellectual capital to achieve it. And like I said, it's very much special situations, deep value investing oriented.
And this is all in the region, right? Not taking internationally or
Exclusively to the region, and within the region, we are predominantly focused on the GCC.
fantastic. Ahmed, one of the things I wanted to talk to you about today was about private credit. I think it's quite an interesting asset class. I did a bit of research before we began this conversation about private credit, and although it's been there for a while in the US, it seems to have really taken off in the last couple of years, especially in 2023. I was reading a report yesterday by the IMF talking about how private credit has performed better than almost all asset classes on an aggregate basis. And it just was really interesting to me. I've heard people talk about private credit and how it's booming and like why it's a good alternative to traditional public markets. Could you try and like define what exactly is private credit?
Um, yeah, I mean, sometimes when people throw that word, throw it around without really kind of attaching meaning to it. And I think to me, private credit is almost a catch-all phrase for, every type of lending that happens outside of the traditional channels, i.e. banks or debt capital markets. Why is it a catch-all? It's because it really captures the entirety of the capital structure for a borrower. And the way a private credit transaction can be structured, you can target a very diverse range of borrowers. What I mean by that is, a private credit transaction it can be senior secured, it could be mezzanine, it could be unsecured and subordinated, it can be asset backed, it can be asset based. The way your returns are derived in a private credit transaction, it could be from revenues, it could be from EBITDA, it could be cash sweeps on asset sales, it could be through equity participation. There's no typical borrower in a private credit. It can be a blue chip company, it can be a high growth and venture backed company, it can be a company in distress, and literally everything in between. So it's a very, very broad spectrum. And I always, find the exercise of capturing the real meaning of private credit as an asset class and an intellectually challenging one for the reasons I just described.
Right. So it's very private. It's not like why do you think it's like really taken off in the last say year or so?
Um, I mean, I think there is structurally a lot of reasons, but fundamentally, what makes private credit, what it is today, is that the providers of capital to the private debt market are very diverse, and they're fundamentally different from the traditional lending channels. So for banks, you have depositors as a primary source of funding. In debt capital markets, you have pension funds, you have insurers, you have mutual funds, etc. Those are the primary funders. In private debt markets, I don't know if you can capture the source of funding in it, right? So but it is everything except the above that I just described. So we have, you will have dedicated private debt funds. You will have sophisticated family offices that, frequently dabble in the asset class. More recently, we are seeing sovereign wealth funds that are building internal, capabilities in private credit. So in general, I think a big factor of the growth here is that you've had, with all the regulation that banks have been subjected to since the global financial crisis and all the regulation that's come in debt capital markets. You've had providers of capital that need to find borrowers that have had to find a different asset class and a different channel to do that, and that channel is what we today call private credit.
Has a lot of this activity been focused in the United States, right, or in developed markets over the past couple of years or decades, rather?
Mhm. That is correct, and again, that's a factor of the market there, right? You had the banks that were strong armed into changing their underwriting standards and changing their risk return criteria after the global financial crisis, but there was still capital available to lend, and that capital in the U.S. found its way to the borrowers in the private debt market through private debt funds, through different channels. But yeah, anything but the banks, basically.
Right. So my next question was going to be the lenders of this kind of capital. Would you class them as like NBFIs, non-bank financial institutions, or would you say it's like a mixture of different organizations?
Honestly, it's a mixture and it's evolving every single day. Like I said, you will find sovereign wealth funds, you will find family offices, you will find dedicated funds, you will find, I even, recently was in a meeting and I found a high net worth guy who was accessing, private debt market through structured notes issued by a bank. So you know what I mean? It's an interesting, how you describe the investor in private debt markets is really evolving and changing all the time. But the asset class, I think, is trending. If that's the question, I think the asset class is trending because of the unique value proposition that lenders in the private debt market offer to borrowers, right? So private lenders are increasingly becoming the financing partners or funding partners to borrowers because of their one, sophistication, two, flexibility, and thirdly, and very importantly, their efficiency, right? So unlike traditional lenders who, as I mentioned earlier, are very prone to regulation and the availability of credit in traditional markets are very much subject to cyclicality or the economic or business cycle. Private lenders have proven over the last couple of decades that they can provide borrowers with capital when they need it, and that they can be there with critical support in challenging environments. COVID was a game changer for private credit, right? When with debt capital markets and banks froze, a lot of borrowers turned to the private credit market, and they found reliable funding partners in what is a once in a century type event, right? Um, and then private lenders, also focus on assets and structures that that are traditionally more complex for your traditional lender to underwrite. And that's a big reason for the increase of the appeal and why it's the asset class is trending, quote unquote.
Right. And from the borrowing side, Ahmed, who usually borrows from the private markets? Is it like companies or entities that can't access the public markets?
I can only speak from my experiences in the region. And again, here it's very diverse, right? So we've had, like, during the pandemic, we've had what I would qualify as blue chip companies approach us for funding because the banks froze and weren't availing capital to them. We've also, in the last few years, what we've seen is a big cohort of startups, successful startups that have scaled commercially, be it in fintech, be it in agtech, be it in more recently in ICT, that have that are underserved by traditional banks, and they've been funding themselves through equity, multiple equity rounds, and now have gotten to a point where founders of those business cannot afford or want to avoid further dilution, and they can't access bank capital. So they will come to us looking for that capital. We've also come to fund a few medium-sized companies or even SME, smaller sized companies that are looking for funding outside of for needs that are beyond working capital, because the banks here in the region have have had a distaste, let's say, for SMEs over the last good decade. And they've limited funding to that segment of the market to working capital. So when an SME is growing and is looking to fund growth or fund corporate action or M&A, they're typically not going to be able to access that funding from the banks, and then they come for alternative capital providers. So
Yeah,
it's a really diverse range of borrowers, is what I'm trying to say.
yeah, no, I got you. Just before we get to the Middle East and what's happening there with private credit, you mentioned earlier about the different types of structures that can be used. Could you go a little bit in more depth, like the kind of structures that are used in like private credit transactions?
Yeah, sure. So when I think about a private debt structure, I mean, there's really no I'm very agnostic whether I'm looking at a bond, a public bond, or a private transaction. But what I would say is, when it comes to private debt structures, there is a different type and level of risk that comes, and the range of returns that you generate as a private debt investor is generally commensurate with the structure that you're using. So, in general, returns in the private debt market are invariably higher than what you will be able to get in a comparable loan or bond. And you will almost invariably have an element of capital appreciation or equity participation as a as a return enhancer. But we've done transactions that have been senior secured structures, and in those cases you will get a relatively stable lower yield, but you also take much lower risk on the risk spectrum. We've also done transactions where we were unsecured or subordinated or mezzanine. These happen lower on the cap stack, and therefore they have a higher yield than say a senior secured. And this is where you will be able to get this equity participation feature. And then there is situations where we've been involved with distressed borrowers, and these are firms that usually will be experiencing solvency issues and very meaningful challenges in their businesses. And therefore, the outcomes or the range of outcomes that you can get as a lender can be very divergent, right? The return scenarios that you're going to be underwriting and the risk profile is very, very different. So that is typically where we command the highest yield and the greatest upside potential.
Very good. And when we look at the region, Ahmed, you've been in the region for about 14 years and you've been in finance for a very long time. It's probably fair to say that the region's capital markets have only really taken off, say, in 2015 or in the last decade, let's say, in the light of lower oil prices and more access to finance. And private credit, to me, it seems quite simple, but like for the GCC MENA, like why do you think this is like an area of the world that it could like play a big role in the economic activity and diversification?
Yeah, absolutely. And it has to. Traditionally, as you're well aware, banks have dominated financing in the region. But I believe that there is a transformative shift underway in the region. This shift has been, as driven by a number of macro factors that, some of which you've alluded to. But I think generally, it's driven by reform, and it's very top down, right? Governments here want to diversify their economies, and they want to stop, being the funder of last resort. And as a result of that, I think we're seeing this, shift away from banks, because banks can't fund everything anymore. And new providers of capital are emerging, and borrowers are seeking those new providers. This shift has really been particularly evident, in my opinion, in certain sectors. So fintech has been, we see it here. We see private debt becoming more and more common, because there's been some landmark precedent transactions in the space. Real estate as well, since the kind of the 20, with the slump in real estate in the UAE, especially, between 2017 onwards. Before the post-COVID recovery, we were seeing, the use of private credit for, last mile finance, for instance, becoming more and more prevalent, and borrowers and lenders becoming more comfortable with those sources. And now, actually, more recently, we even see some banks doing it. And then we're also seeing, I see it very evident, the comfort level with private debt is more evident with certain borrower types. So startups, for the reasons I mentioned earlier, right? Like, founders don't want to get diluted anymore once they've scaled up their businesses and proven commercial concept. Like, you can't fund the business with equity forever, and doing so misaligns the interests of the stakeholders, and you need the founders to stay and protect them from dilution. And that's where private credit comes into play. We've also seen it with distressed borrowers, NMC being a case that we were involved in with the rescue financing of NMC. That was a landmark precedent transaction when there's been a number of transactions go through the system. So there's more acquaintance and comfort around that, both from borrowers and from capital providers. So in my view, in the region, just like anywhere else, alternative finance providers have been able to bridge this, liquidity gap, and they're offering capital to pockets of the market that have, historically been underserved by your traditional bank funder. And that's the value of that cannot be discounted in the region.
Speaking of funding needs, Ahmed, one thing I wanted to ask you is that in places like Saudi Arabia, for example, obviously under Vision 2030, which came out in 2016, and it's been really accelerating, a lot of, and also I would say in the UAE and other countries in the GCC as well, is that the sovereign wealth fund, or like sovereign arms, or sovereign investment companies rather, are drivers of private sector, or rather economic activity. Do you think that could potentially like crowd out the private sector lending to companies or entities that really need financing?
I think it's a very good question. I mean, I think there was some risks or concerns around crowding out in Saudi, particularly over the last couple of years. And what and I think though a lot of those concerns have been overblown, in my opinion, and sensationalized, because the government and the sovereign wealth funds and their government related entities in general play a very critical role when it comes to capital formation, and they need to be there early on when you have such huge ambitions. The private sector is not going to pick up the bill and take all that risk in that early stage. So you need active involvement from the public sector to be able to take that risk initially, and then slowly and progressively start handing the baton to the private sector. And we're starting to see that in Saudi. I mean, we went from a period where everybody was, talking about crowding out from PIF, and PIF is buying the entire construction supply chain, etc. Now the project award cycle is really kicking off, and all the new projects, from what we gather, are primarily going to the private sector, and it's the private sector that's looking for funding, and Saudis are putting their the private sector in Saudi, families, merchant families, businesses, they're all investing in their country, and frankly it was the PIF that enabled that kind of risk taking at this stage.
Very true. One other area I wanted to ask you, with staying on the Middle East, was we had Sharif Eid on a couple of episodes ago talking about the region's capital markets, and he was very bullish on private credit's opportunity with regards to high yield sukuk. How
Mm,
you mentioned, I think, that it's quite agnostic, like it's not, it could be a bond or
mm.
how can private credit help is high yield Islamic instruments, do you think?
I don't know how I can answer that, because um, I think from increasing the appeal of a private credit transaction by making it Sharia compliant, I think that makes a lot of sense to me. And we have done that because you're able to attract capital from pockets of the market that are may not be available if you just do this as a purely conventional financing. So yes, I mean, it is there is a lot of Sharia compliant capital that's looking for a home, and private credit can be a potential channel for that capital. And if you just look at debt capital markets, right? Just in normal capital markets, you will always notice that the sukuk trades inside and at a spread and yield trades inside its comparable conventional note, which speaks to the level of demand and the volume of capital, the quantum of capital that's available in that market that's seeking yield. So um, yes, I think Sukuk can play, and Sharia financing can play a very important role in the evolution of the private debt markets in the region.
Yeah, because if you think about it, like a lot of issues that issue sukuk in the GCC are highly rated, government have some kind of government link to them. They're very highly
Hmm.
rated, and the issues that need capital, for example, but can't afford like a credit rating, or kind of don't have good credit metrics for a rating. Private
Hmm.
credit seems like a natural way for them to raise this kind of funding.
Absolutely. I mean, fundamentally, for us, from just a pure risk return perspective, right? Our strategy is very much absolute return driven. We think that the GCC truly offers a very, very attractive trade-off and especially in private debt. For starters, despite the high-profile defaults that we hear about that get sensationalized in the media, whether it's NMC or Abraj, I think the region gets unfairly tarnished by these cases, because fraud and bankruptcies and ill fortunes happen in all markets, but we get sensationalized unfairly. But in my experience as an investor in the region for the last 14 years, I've found that borrowers generally exhibit a very high degree of respect for capital, um, which is critical, and is truly something that cannot be discounted in the underwriting process, right? You can do whatever you want in the Excel spreadsheet, and you can forecast and model whatever you want. But ultimately, if the borrower, the sponsor, is not somebody that has respect for your capital, you're running a very high risk of permanent loss of capital or capital impairment. And I've found that generally borrowers in the region have a great degree of respect for capital, and there are situations where the challenges is the businesses that we've lent to have encountered some really um, extreme challenges, especially during the pandemic, and we found the sponsors, you know, look for creative ways to ensure that they stay in compliance and within covenants, including bringing equity, selling assets, creative solutions to make sure that they're evidencing and demonstrating to you that they're respecting your capital. So to me, that is such a qualitative and often overlooked factor that makes the GCC a very attractive, or MENA a very attractive place for private debt investors. Then on top of that, you have legislative frameworks that are uh, very, very rapidly evolving, and they're quickly converging on international best standards when it comes to insolvency, creditor protections, enforcement, etc. You've also had, especially in the UAE and Saudi Arabia, you've had some very complex, large cases go through the court system at different levels, and set precedent for how things should be done, and templates for us as investors and how we should model future outcomes, and therefore reduce the risk. Um, and despite everything I just described, the asset class is still in its infancy in the GCC, and the market as a whole is still very underinvested. Therefore, the returns here are higher in order to attract more capital. And we're now starting to see that new capital, provide, alternative capital providers in Europe and the US waking up to this opportunity set and starting to, muscle their way into the region and build their comfort levels here.
Yeah, it seems like every week when you read Bloomberg or the FT, you see like all these multi-asset fund managers setting up private credit funds in places like Abu Dhabi and Saudi Arabia. So I guess they want to get in on this bonanza before it goes, right?
Yeah, I mean, it's not clear to me whether, I mean, I think a big element of those funds relocating here is for tax efficiencies, frankly, from speaking from firsthand experiences and interactions with many of those managers. And then there's also, but sovereign wealth funds are awash with cash at the moment, and they're trying to build and attract those managers in order to import the know-how and create this knowledge transfer, in order to build the investment management industry here properly. And I think that makes to me a lot of sense. Now, whether these managers are investing in the region or not, or taking capital from sovereign wealth funds in order to invest in other parts of the world, which probably makes sense from a diversification standpoint for the sovereigns. The fact that these managers are relocating their analysts and their CIOs and building those capabilities in ADGM and in Riyadh, long term, that's positive for asset management and investment management industry in the region to have that ecosystem.
Yeah, for sure. Ahmed, as we bring the podcast to a close shortly, one of the things, or what the areas I wanted to talk to you about was, obviously it seems all positive, but also there are risks related to private credit, right? What would you say are some of the biggest risks facing the private credit globally and also in the Middle East?
Sure. Now, I don't know. I can't speak globally, frankly, but I mean, just speaking from my experiences in the region, I think the most uh, visible or prominent risk in my mind when it comes to credit investing in general is always capital decay. This really is the greatest risk. Avoiding default and permanent loss of capital should be, the single most important criteria in anyone's underwriting process. So that because of the nature of the borrowers in private debt markets, I think that risk is more elevated than elsewhere. Um, so that requires tougher underwriting criteria than what you would do in the bond market. Um, Second is the illiquidity. You need to be in a position and you need to be comfortable as a private credit investor to hold the asset through different business cycles, and to have the patience to work with the underlying borrowers through those cycles until you find, kind of the right exit point for you. And then, but just kind of perhaps maybe directly given the pretty magnificent rise of the asset class, and the generally low touch regulation. And I think regulation is a pretty high risk here. It's coming. Private credit, the data is it's not really complete, but there is a sense that private credit is becoming systemic. So it's just a matter of time where I think regulation is gonna come to regulate the type of funds that are raising money for private credit, and the type of structures that you're to the type of transactions and structures that you're making, to make sure that there's no usury or no aggressive tactics being deployed. So those are in my mind probably the greatest risk: capital decay, liquidity, and regulation.
I've got three questions for you. The first is, do you think like the region's legal infrastructure with regards to things like bankruptcy or insolvency, do you think that they've been like really tested in like a difficult private credit situation?
The short answer is yes, but it is something, more work needs to be done, right? So we were directly involved in NMC Healthcare when that company entered into administration. And we saw how, swiftly legislation was changed in order to allow for the orderly reorganization of that business and its ultimate exit from administration. So that was, and during that case, there was even a precedent where a debtor in possession financing structure was put in place, and that created a template for future transactions. But it is, it's a process by trial and error, but the best intentions are there. In Saudi, we saw, cases that were stuck in the court system for over a decade in AHAB and more recently SAD Group, go through a process and now come out of that process, and creditors, achieving recoveries after throwing in the towel. So I think there is more work to be done, but in terms of application, it's there, and in terms of ability to kind of learn and improve. As I said, the swiftness by which legislation gets modified and to improve is quite impressive in the region. I think you don't have legislative bureaucracies and parliaments where you can get stuck in debate for 20 years over something, with parliamentarians serving different vested interests. Right here, it's let's do the most efficient thing, and it's down to business.
And then my second question, they're kind of two questions in one, is that the IMF pointed out and others have pointed out that one of the risks in doing private credit is the currency risk. So obviously in the GCC, other than say Kuwait, your currencies are pegged, so there's no real FX risk per se. But if oil prices go beyond a certain level or dip beyond a certain level, doesn't that pose a risk to private credit?
I mean, it poses risk to every asset class in the GCC, right? I mean, despite of all the diversification efforts, I think our markets are still very much influenced by commodity, the prices of oil as a commodity, right? Because that dictates the level of liquidity that's available in the market. So I don't think it's unique to private credit. I think the risk probably maybe a little bit more amplified because of the nature of the borrowers that are higher risk in the private credit market. But I don't think it's something that is exclusive to the region, exclusive to the private credit market.
And my third question, Ahmed, is just sticking on the risks, is that, there was a piece in The Economist about a decade ago, I remember reading, talking about shadow banking in China, and
Mm.
how it was really successful. And then, obviously you've seen over the past couple of years, the Chinese economy struggling and that it's shown a bit of systemic risk. Do you think there's a potential here that if private credit does, do well in the GCC, Middle East by extension, you could be creating a systemic risk to the wider financial sector?
I think we are really far away from that. Like the asset class is still very much in its infancy. Um, and if I was to look at the amount of debt funding that happens in the region, and I look at private credit as a percentage of that, it's tiny, tiny fraction. So I don't think it poses, in my opinion, I don't think it poses any systemic risk. Um, and and I also think the risk is to an extent mitigated by level of regulation. So regulators in the region are learning and following international best practices when it comes to how to govern private credit funds and the investors that go into private credit funds and how private credit funds can raise their capital and how they can deploy that capital. So we've seen a lot of changes in the IFC regime for private credit funds. Similarly, in ADGM, we understand, there was some, more regulations that came on NBFIs in Saudi, same thing on onshore in the UAE. So I think, they're striking a very good balance in allowing the asset class to flourish without, kind of creating any pockets of systemic risk.
And you see most of the activity taking place in places like Abu Dhabi, Dubai, KSA, right? Not really much happening in Bahrain or Qatar, other countries.
No, I think no, I'm not seeing. It's funny. So we actually do a lot in countries outside in the GCC and countries outside the UAE and KSA. But the markets are definitely a little bit less efficient over there. So we have some investments in Kuwait. We also have some investments in Qatar. Things are move at a slightly slower pace, but reform is there, and the will to reform is definitely there. Now, in when it comes to private credit outside, I think when I look at Qatar and Kuwait, in Qatar, the bank is still very much sorry the market is still very much driven by banks. And banks are generally very, very liquid in Qatar and well capitalized. They've gone through, their post World Cup hangover and digesting a lot of NPLs from real estate, tourism, and construction. But generally, the banks are very well capitalized and have appetite for lending domestically. But their underwriting standards have tightened. And also, but the scale of the opportunity is not the same. Like when we look at it, it's a small market than say the UAE or KSA. And Kuwait generally is a slower growth market. But at the same time, the banks are very well capitalized and corporate borrowers in those in Kuwait are well served by the banks. Bahrain, we haven't done much in Bahrain to be candid, so I can't really comment on it. We have some portfolio companies that do cross-border business in Bahrain, but we haven't done any direct lending or private credit to borrowers from Bahrain.
And more broadly, outside the GCC, do you see opportunities for private credit elsewhere in the Middle East?
The short answer is no, I do not. I don't think any of the countries outside the GCC have the will for reform to attract, capital. So, those markets I think, are a little bit more challenging for credit investors. So we've looked at, some opportunities in Egypt. We've looked at opportunities in Jordan. And they didn't cut the mustard when it comes to our underwriting standards, unfortunately.
Fair enough. Fair enough. Ahmed, tell us more about what you're up to and if you've got any like interesting upcoming projects.
I mean, it's I mean, my singular most important project is managing our funds and delivering returns to our investors and executing our fiduciary duties to them. So that consumes 90% of my time. In terms of in terms of projects, I mean, we're constantly looking at new opportunities. Both, as I mentioned, we have we look across the corporate balance sheet, and we do um, credit and equity in public and private markets. So we're constantly looking at new opportunities, and we have also existing opportunities within our portfolio with portfolio companies that are growing and need new funding. So we're focusing on that. And like I said, when earlier we our pipeline is busy with startups from the region that are looking for non-dilutive or less dilutive financing solutions. So we're spending a lot of time on the startup ecosystem in the region and structuring some venture growth debt solutions for them. So
Fantastic.
yeah, that's our consuming 90% of my time, as I mentioned.
Great. And the other 10%, do you spend on social media or write your thoughts on
Uh,
Substack?
no, I have outside of my LinkedIn, unfortunately, I have zero digital footprint or social media footprint, let's say. So if anyone is looking to reach out to me, I think LinkedIn is possibly the only visible channel out there.
Okay, great. I'll link your LinkedIn profile in the show notes. So if anyone wants to reach out to you, they can reach you via LinkedIn.
My
Um,
pleasure.
but Ahmed, this has been a fantastic conversation, and I wish you all the best for the rest of 2024 and going into 2025.
Thanks, Hassan. It's great to be in touch again and appreciate you making the time.